Do you know what makes a profession a profession? A profession has its own language, its own vernacular, its own way of speaking. Think about this. If you go to the hospital and you hear two doctors discussing you or your loved one's medical condition, most times you can't pick up 100% of what they're saying. If you're gonna go hang out with your buddy who's in law enforcement and they were with a bunch of their friends who also are in law enforcement, they're gonna start using a language that, well, quite honestly, you don't understand. It sounds like they're speaking in code because they are. Well, in the mortgage industry, we have our own vernacular because we too are our own profession. So I'm gonna share with you my 10 favorite acronyms that I think anyone who's looking to purchase real estate, sell real estate, or become a mortgage loan originator, these are the 10 that you just gotta know. So here they are. I'm gonna start with ADU. ADU is a newer acronym. It stands for Accessory Dwelling Unit. Think about this. You wanna buy a house, and that house has a mother-in-law suite, and you wanna rent out that mother-in-law suite in order to make that home more affordable for you. That mother-in-law suite is called an ADU. So you're gonna wanna look for a loan program that allows you to use ADU income to help qualify for the home purchase. Sticking with the A's, my next one, AMI, Area Median Income. The reason why this is important is that affordability is a big issue for purchasing real estate in the United States. And a lot of the down payment assistance programs are specifically developed for people or households who earn within a certain limit of the AMI. AMI stands for Area Median Income. So certain loan programs that are specific to first-time home buyers may only be available if your AMI is under 100% or if it's less than 120%. So understanding that AMI is a component of qualifying for certain loan programs, especially down payment assistance, is important. And more specifically, understanding that AMI stands for Area Median Income. AUS. So there's no way that you can be a successful loan originator without understanding what AUS stands for. It stands for Automated Underwriting System or Automated Underwriting Software. Just depends on who you ask. Tomato, tomato, in my opinion. What AUS is, it is the computer algorithm that we as lenders are given access to run particular home buyer scenarios through, and this computer algorithm ultimately is going to be able to let us know whether or not we have a pre-approved or an approved buyer or not. Fannie Mae has their AUS, we call it DU or Desktop Underwriter. Freddie Mac has theirs, we call it LLPA. So when you're trying to qualify for a home loan, please understand that 99 times out of 100, your lender is going to take down all your information, they're going to verify its accuracy, and then they are going to run AUS. When they run AUS, they're essentially going to put your scenario with the verified information through a computer algorithm that then is going to give a finding or a reading. If we're running you through DU, we want to prove eligible. If we're running you through LPA, then we want an accept. Now, if you don't receive an approve eligible or you don't receive an accept, it's not the end all be all, but please know we now have to downgrade your particular loan file to what we call a manual underwrite. And when loan files are underwritten manually, they're typically underwritten to the most conservative of the underwriting guidelines. The benefit of AUS or running a file through AUS or utilizing AUS in the underwriting decision-making process is a lot of times we can get exceptions that allow us to qualify mortgage applicants for loans that ultimately were a little bit outside of the scope of what the guideline states, but because of compensating factors, the algorithm accepts the risk profile. BIPs. Please don't call it beeps. BPS, basis points. Basis points is a vernacular that comes from bond traders. Bond traders on Wall Street talk about things like ticks and BIPs. It's basically a fraction of a fraction. So in my world, if my compensation was going to be 100 basis points, 100 basis points equals 1%. So if someone were to talk about something being 50 bips or basis points, BPS, what they're talking about is that being 1/2 of 1%. So another example would be the Federal Reserve just decreased the federal funds rate by 25 basis points. Well, 25 basis points is 0.25%, or it's 1/4 of 1%. What does that mean? It means the Federal Reserve just dropped interest rates by 0.25%. You'll see it designated or denoted as BPS. We call it BIPS. Weirdos call it beeps. There's a little bit of a tomato there, but I think the industry standard is we call it BIPS. It stands for basis points, and basis points is our way of talking about things in percentages. So 200 basis points is 2%, 10 basis points is 1/10 of 1%. Hopefully you're picking up what I'm putting down. Next on the list is COE, or Certificate of Eligibility. Now this is only important to our veterans and our active duty military who are looking to utilize their VA home loan benefits. One of the first things that we have to do as your lender is we have to determine your eligibility. We do so by reaching out to the VA and obtaining your COE, or your Certificate of Eligibility. Sticking with the C's, the next acronym is CTC, or Clear to Close. These are the 3 best words you can ever hear when you're financing a home. This means that the underwriter has fully approved your loan. They've dotted every I, they've crossed every T, they've audited the auditors, they've quality controlled the quality control, and you are good to go. Your funding's going to go through. You're going to be able to purchase your home. Congratulations, you are CTC, or Cleared to Close. We cannot originate a home loan. We cannot issue a pre-approval without first talking about your DTI. DTI stands for debt to income ratio. It is very important when qualifying for a mortgage. What is your DTI? Well, technically, you have a front-end DTI and a back-end DTI. Your front-end DTI is essentially what is your total monthly housing obligation divided by your total gross monthly income. When you divide, let's say, $1,000 a month, which would be your housing expense in this example, by $5,000 a month, which would be your gross monthly income in this example, we would know that your front-end DTI is 20%. Well, that is very healthy. DTI is debt to income ratio. Now, your back-end ratio, well, what if we took that same $1,000 a month housing payment, but this time we're going to go ahead and add in, I don't know, $1,000 car payment, and we're going to add in $250 worth of credit card payments. Well, now all of a sudden, your total debts that you're obligated to pay, outside of things like groceries and utilities, because they actually don't get factored into your DTI when qualifying for a home loan, all of a sudden your total monthly payments are $2,250 a month. Well, when I take $2,250 and I divide it by the $5,000 a month that you make in gross monthly income, well, now all of a sudden your DTI is 50. That's your back-end ratio. Well, back-end DTI at 50 starts to get a little bit alarmingly high, and you could potentially not be able to qualify for much more debt when it comes to qualifying for a home loan. So DTI, debt to income ratio, you have a front end and you have a back end. The next acronym I want to discuss is HOI. HOI stands for Homeowners Insurance. When you own a home, you want to protect that investment. You protect that investment with insurance. Just like we have auto insurance for our cars and we have medical insurance for ourselves, we need to have homeowners insurance for our real estate. And when you have a mortgage on your home, it's mandated that you keep HOI, or homeowners insurance, because your home is the bank's collateral. Now, when you're factoring your monthly payment, you have to factor in HOI into your budget. Most mortgages will have you pay a portion of your homeowner's insurance each month with your monthly mortgage payment. So HOI is important because it is your homeowner's insurance. It's factored both into your monthly debts as well as something that you need to protect you and your lender against your home being damaged. LE stands for loan estimate. When you're applying for a home loan, your lender is going to give you an LE. That LE is a document that you're going to want to spend some time reviewing and also reviewing with your lender. Make sure you ask questions because every important aspect of your purchase transaction is going to be listed on that LE. LLPA stands for Loan Level Pricing Adjustments. This is where you as a consumer need to understand that, well, there's no such thing as a one-size-fits-all mortgage, and there's not just one standard interest rate. There's about 21 different factors that go into your interest rates. Those factors are called loan level pricing adjustments. As certain loans are deemed riskier, then what you'll see is you'll have to incur some of those loan level pricing adjustments for the negative. If for whatever reason there are certain attributes or aspects of your loan file that are deemed to be least risky, then you can see some LLPAs work in your favor where you're given pricing discounts. But of the 21 factors that go into a standard mortgage interest rate, if there ever was such a thing called a standard interest rate, please know your loan size, whether it's too small or too big, will come with an LLPA. Your credit score is probably the biggest factor. If it's too low, you're going to have multiple LLPAs, and if it's really high, you may have an LLPA to your favor. Now, whether you buy a condo, a townhome, or a single-family home, they all come with their own LLPAs. So you can see where there is no such thing as a standard fixed rate that's the same across the board. Every person, every scenario, every situation has its own moving parts. And within those moving parts, there are various loan level pricing adjustments that will be made to your interest rate. And this is most prevalent when you're doing conventional conforming financing, such as loans that are backed by Fannie Mae and Freddie Mac. The next very important acronym that you must understand is PMI. PMI stands for Private Mortgage Insurance. Just know this, anytime you are not putting down 20% or greater as a down payment, more than likely you're going to be required to have some form of insurance that insures not you, but your lender against you going into default. Now that PMI can be paid monthly, that PMI can be paid all up front, that PMI can be paid all up front by you, it can be paid by the seller, or it can be paid by the lender. But your loan, 99 times out of 100, when you're doing a conventional conforming loan and you're not putting down 20% or more, you will have PMI. PMI stands for Private Mortgage Insurance. And know this about PMI. The more money you put down, the least expensive your PMI becomes. The least amount of money you put down, the more expensive. The higher your credit score, the cheaper your PMI. The lower your credit score, the more expensive your PMI. And PMI is not a bad thing. PMI is it is what it is thing. And many of us, when we're buying our first homes, we pay PMI. And a very good loan originator can walk you through examples of how you can pay PMI up front, you can pay it monthly, you can have the seller pay it, you can have the lender pay it, or they can even show you options to not have to pay PMI, but maybe take a slightly higher interest rate because that is what's going to make your monthly payment the cheapest for potentially your potential scenario. All right, so now let's go ahead and close this out with the V's. I'm talking VOD and VOE. A VOD is a verification of deposit. This is where your lender is going to reach out to your bank to understand your banking transaction history for usually the past 60 days. So they want to see what your average daily balance was, and they want to see what your current balance is over a 60-day period of time. And a lot of times, a lender will order a VOD because for whatever reason, either they don't have access to your bank statements or they don't want to use your bank statement because utilizing a VOD is what's going to be best to get your loan application approved the smoothest, the quickest, and the most efficient. Now a VOE, it's another verification. So the V stands for a verification of, this time employment. So a verification of employment can be as simple as picking up the phone and calling your HR department and making sure that you still work there, or it could be as intrusive as sending over a written document at which point we have your employer, we being the lender, has your employer spell out your start date, spell out of your compensation, how much is base pay, how much is overtime, how much is bonus, how much is shift differential, and even answer questions such as, what's the likelihood that this overtime or this bonus income is going to continue? What's the likelihood that your employment with said employer will continue? So you have VOD, which is a verification of deposit. That's where we're checking in on your assets. And a VOE, or even a written VOE, is where we're checking in not just on your employment status, but potentially even how you're paid and the likelihood of that income is going to continue. Now, that was a lot, but believe it or not, I'm just getting started. So if you would like to tune in to an entire episode that we created a few years ago, where we discuss in greater detail the acronyms and the jargon needed in order to best understand the mortgage lending profession, go ahead and check the description below, because we're going to have a link to that past episode. On top of that, if you're a mortgage loan originator and you would like a downloadable resource so that you can print out not just these that I covered in today's video, but all the other ones that we didn't have time to cover, go ahead and click the link in the description, and we will make sure that you get for free a copy of this PDF that walks you through the majority of the acronyms you need to know in order to be a successful, seasoned mortgage professional.